During June, Friday will earn half a month fee for the work done on June 15 through June 30. On June 30, Fridays makes the following adjustment. Here we go. Entry would be account receivable to service. Understand? Because we are right now on June 30. Work is going to be finished on 15th of July, right? So half of the work already done. So half of the revenue already earned. But you will be paid on when work is complete. So that is why you record the half revenue. Remember, revenue or in combined sense, matching principle. Revenue recognition or expense recognition combined, we call this matching principle. Understand? Jordan, Sipade.
Yes, sir. Yes, got it.
Yes, sir.
Yes, sir.
Min, Jaffer,
Yes.
Chloe, Ajim,
Yes.
Guntio, Nisha, Ping Ping.
Yes.
Okay. Okay, now let's talk about this. Suppose Friday's Auto Service Incorporation holds a not receivable as an investment. At the end of the June, $100 of interest revenue has been earned. Right? Journalize the accrued revenue adjustment at June 30. Can you do that? Simple. Receivable. Because you give the loan, you receive revenue, interest revenue. You earn the right to record revenue, that's why you call this revenue. You are not paid yet, you create receivable. Simple. That interest occurred but not yet received. Now unearned revenue, which means cash received before revenue recorded, or you receive the cash before earning the revenue or before sending the goods to the customer. The examples are customer deposits, magazine subscriptions. So normally we pay subscription for the whole year. So we, as a customer gave you your whole year's sales in advance. So your air ticket payments, these are also called earned revenue since you did not travel yet, but you pay to the airline. For airline, these are revenue? No, because the airline still did not provide you the service. Until you reach your destination, then they can record that this is the revenue. Similarly with the rent, if you are in a renting business, remember renting business, if you receive rent in advance, then that becomes your unearned revenue. It's not like a rent payments, because rent payment in advance, that is your asset. We call this prepaid rent. So this is called that you are in renting business. You provide rent. Like in Shanghai, there are many companies who have this renting services. So for their rent is their sales. Let's do this example. Suppose Home Depot engaged Friday's Auto Service Incorporation to perform routine oil charges on Home Depot trucks, agreeing to pay Friday's $400 monthly salary, beginning immediately. It means you're paying in advance. If Friday's collects the first amount on 15th of July, then Friday's will record this transaction as follows. How much is that? You receive cash, right? But did you perform the service? Not yet. Right? You did not receive, you did not provide the service yet. You receive the amount first, and then the truck's going to come to you, and then you go through oil changing. So the accrual accounting, whatever is done on that day, you must record. So on June 15, what happened? You receive cash against a service that you need to provide later, but you need to record it here right now on the same day. So you receive cash according to your service or revenue, which you will provide later. So that is your liability. Remember, that is not your sales. That will go to balance sheet, not the income statement. Remember this one. On June 30, unadjusted trial balance list unearned service revenue, 400 credit balance. During the last 15 days of the month, Friday will earn one half of the 400 or 200 as the services. So you see here, the Home Depot will give you monthly. So they pay you on June 15. So their months end on July 15. And you are preparing your trial balance on June 30. It means 15 days of the cash that is you receive, you have a right earned. When you receive the right call earned, then you can record it. So you have created a liability, 400 as unearned revenue. So 200 belongs. So now you earned that one. So you need to decrease that liability. So decrease in liability is debit. So unearned revenue 200. And since you have increased your revenue, so that is becoming your normal revenue, which is the service revenue. Simple. See? So now the balance for unearned revenue decreases on 30th of June, 200, and your service revenue start increasing. These are some just fictitious numbers. Not this. These numbers are. Just to make you understand. Now, so how the entry looks like. So this is basically giving you a small summary here. So prepaids, when prepaids means cash first. You pay cash and record the asset later. So when you pay cash first, cash would be decreased. Cash would be on credit side and prepaid would be on debit side. So entry would be prepaid to cash, right? So first entry gonna be when you pay the cash in advance, and then when that asset is going to be decreased, then you see here expense to prepaid expense. If this is rent, then rent expense to prepaid rent expense. If this is the subscription, no, not the subscription, it is like prepaid insurance, then insurance expense to prepaid insurance expense. You guys understand the logic here? Everyone? And then we have unearned revenue. Unearned revenue. In unearned revenue, first what happened? You received the cash and you didn't earn the right to recognize the revenue. So simple, cash received, so cash gonna be first, and then you write it down your complete sales. And then how much sales is gonna be recognized, you make a reverse entry. So this is the sale that you recognize against unearned revenue. So you create a liability. So you need to decrease that liability. When you decrease the liability debit against, now this is that you have a right to recognize. And then accrued expenses. Accrued expenses, expense occurred but not paid. So when expense occurred, not paid, you make the entry expense to payable, you create a liability. But when it is paid, then you decrease the liability, pay to cash, simple. Accrued revenue, which means revenue occurred but you are not paid, first of all. So account receivable, you create account receivable, you create asset, account receivable to revenue, and when you receive the cash, then you create or you decrease your receivable against cash. Right? Okay, summary of the adjusting process is like that. Two purposes of the adjusting entry. Number one, in order to measure the income and to update the balance sheet. Like how much left in our prepaid account, how much left in our supplies, how much left in our salaries payables, how much salaries are not yet paid, right? So if salaries are paid, then they come to the income statement to measure the income, right? So therefore, every adjusting entry affects both revenue or expense to measure the income, asset or liability to update balance sheet. So in every previous example here, one of the account belongs to income statement, other is balance sheet. This is, no, at first one occurred. You see here, receivable, balance sheet, revenue, income statement. Similarly with this one, prepaid expense to cash, cash to unearned revenue, right? Expense to prepaid expense, right? So they are also affecting the income statement and balance sheet. So this is a summary. When prepaid expense occurred, they must be debited and they are assets. Depreciation type of account is the expense and it's a contra asset account and it is credited. Right? Similarly, unearned revenue is our liability. Liability against what? The revenue. Accrued revenue right now is our asset because accrued revenue occurred against account receivable. Right? And the credit side is revenue. Right? So let's take a break, 10 minutes break, then we start our next topic.
Sir, the class is until 8:30 now.